Hello and welcome everyone. My name is Hector Del Castillo, Chief Product Officer at Byond, and I would like to welcome all of you to today's webcast. Today's topic is 9 things ultra-successful M&A project leaders do differently. And this will be an engaging discussion to identify how to become an ultra-successful M&A project leader. Last year, 19,501 companies changed ownership in North America and Europe alone, for a total M&A deal value of over $3.5 trillion. This is according to PitchBook, a marketing research firm that tracks M&A markets. That means business leaders are managing over 19,501 business transformation projects today because that's what they do after each and every deal is closed. But how well are they executing them, and what have they been planning to do? Are they using project management best practices? Do the executive teams understand the importance of their roles as project sponsors? With a failure rate of over 70% according to experts, if any business or any market is crying out for a need of project management, it is the M&A market and industry. In this discussion, you will learn how to successfully manage and lead M&A projects based on my experience of serving and managing many large business integration projects. And we will focus specifically on understanding why there is such a high M&A failure rate, and we'll define what M&A failure means. So let's go ahead and get started. Before I get going any further, I want to give a special thanks to the Great IT Professional, Wendy, and everyone else at the Great IT Professional for actually hosting this particular webcast. I think it's a great venue for project leaders and IT professionals to share their knowledge and figure out how to get more education and get into newer topics, emerging markets, and learn not just about new technologies, but also ongoing issues that are plaguing the IT industry, but also challenges to the IT industry for those of us that are working in the technology fields. Also, if you want to follow us and you're actually using social media, you can actually use the Byond hashtag @ByondMA, my own @HMDelCastillo, to share anything that we're going to be discussing today on Twitter. And you can use the hashtags digital and merger and acquisitions. So hashtag digital, hashtag mergers and acquisitions, and you can use also share on LinkedIn post, and we will be able to share and like and follow any comments and follow up comments either during or post today's discussion. And today's discussion, I want to start. We mentioned that the total volume was over $3.5 trillion. This is just the volume of deals that occurred in 2018. It was over $2.2 trillion of just deals involving North American companies. And this equated to the second all-time high record of M&A deals over history. I believe the only exception was in 2016 when there was a larger volume. But even if you look at today, the total volume, even though it's the second highest, it involved 11,208 deals of U.S. companies, and that represented a 6.9 increase in total deal value in that year of 2018, but it represents a decrease in the deal volume, a decrease of 11.4%. So what does that really mean? It really means that each deal is getting more and more expensive to do. That's what that data is showing in 2018. The deal value is going up, but the total number of deals is going down. And this is a second all-time high for the U.S. market. And yet you find multiple sources of experts tracking the M&A market, and they're all saying that there's a high failure. And we'll talk about what failure means when they're tracking failure, because due diligence and other things that are part of the M&A process is exactly to capture deals that are not going to achieve the synergies that either party is looking to achieve before the deal is even closed. And so often there maybe is some lack of terminology or lack of definition as to what is the expected failure rate, because you want the failure rate to occur before any kind of agreement has been signed off between parties, and that is why due diligence has to occur. So we'll talk about where some of these failures are occurring along the product lifecycle, and we'll talk about the the M&A lifecycle itself for any M&A deal. So why is it so important for companies to do this? Well, a base study that was actually published in 2011 or 2012, around 2011, 2012, looked back and studied a whole decade of information of companies, and they looked at companies that don't do any M&A deals, and they just focus on organic growth, and then they compare companies that are doing inorganic growth on an ongoing basis. And they were looking to actually answer this question: which of these two growth strategies yields a higher total shareholder return over a 10-year period? So they look back at all the companies and their performance of those companies across industries, and they looked at the ones that only focus on organic growth versus the ones that focus on doing inorganic growth on an ongoing basis. Which one do you think yields higher total shareholder return? Those companies that focus on inorganic growth on a consistent basis actually achieve higher total shareholder return compared to those companies that only focus on organic growth alone. And why is this important? Because inorganic growth is actually achieved through mergers, acquisitions, and divestitures. And that's what the companies that do inorganic growth are actually doing. And what we're finding out is that companies that do inorganic growth don't just focus on inorganic growth. They're actually doing both organic and inorganic growth at the same time. And this is the reason why, on the average, regardless of the market and regardless of the industry they're in, and regardless of the type of business they're in, the ones that focus on inorganic growth actually achieve higher total shareholder return compared to those companies that only focus on organic growth. So that's one of those aha moments for many CEOs that are driven to actually improve the performance of their companies. If you're an executive and you're only looking at organic growth initiatives, I would recommend that you start looking at inorganic growth initiatives as well, and figure out how to get really good at doing both organic and inorganic growth based on the results of this study. So, as a matter of fact, what happened because this actually happened immediately after that post-Great Recession that we encountered here in the U.S., in the North America market. And we were showing that many companies that actually realized a turnaround post-Great Recession through inorganic growth initiatives. So the current situation is what we're going to be discussing of the M&A market first, and then we're going to get into actual things that if you're involved in leading projects that have to do with M&A deals, and you're actually leading inorganic growth initiatives within your company, what are those characteristics that you should have if you want to be an ultra successful project leader for M&A initiatives within your company? So let's talk about the current situation first. Current situation is, number one, PitchBook is saying, and they track, this is actually the entire 2018 period. This goes back to the data that I presented earlier, 19,501 deals that equated to over $3.5 trillion total. This is North American and European activity. And out of that, this is how much was actually invested by private equity firms in U.S. middle market companies. So you can see that out of the $3.3 billion and out of the over $2.2 trillion that was spent in North America, a good chunk of this represents investments of middle market companies, because the flow of volume involving U.S. middle market companies in the same time period, 2018, was $428 billion of deals that were closed in 2018. So what does that mean for the middle market specifically? This is the companies that Byond really focuses on, is the middle market companies. And these middle market companies are usually ranged in size, number of employees, but also in annual revenue, somewhere between 10 million to up to $1 billion of annual revenue. And in employee side, in number of employees, they range between 30 employees all the way up to maybe close to 1,000 employees. That's the definition of middle market companies in US. And this is what this is showing. 2,971 total number of deals that equated to just under $428 billion in 2018. And you can see that there's an ongoing track record that from year after year, year over year, from 2013 to 2018, the number of M&A deals involving U.S. middle market companies has been on the rise. And 2018 was a record year involving M&A deals involving U.S. middle market companies. So if you're a middle market company, you're in the sweet spot, and current data is showing that most anybody who's interested in investing is looking for suitable middle market companies, U.S. companies, to invest in for the future. The other thing that the data is showing regarding the total M&A market in U.S. is that deal value for technology companies is going up. Last year, in 2018, it grew to 31%, and it's been growing annually at 31% for the last 5 years. Not only that, but also technology deals are shifting from scaling companies to increasing the scope of companies involved. And we'll talk about the difference between a scale deal and a scope deal as part of what we cover later on in this discussion. In addition, most big tech deals over the past 3 years have reflected some type of scope, and scope can be based either on providing grading connectivity for goods and services being sold in markets. It could be about accelerating migration to the cloud and adoption of SaaS solutions. And it's also about deals that give you secure access to proprietary data that allow companies to make smarter decisions based on the data that they have access to. And a brief discussion on some of these deals that went on in 2018 that had to do with any of these three different themes. So you can see the pattern is that, number one, most companies that are looking to grow right now, post-Great Recession, are not just using organic growth, they're using also inorganic growth to outperform competitors. And the number two issue that becomes after looking for both organic and inorganic growth initiatives is to figure out how to maximize the synergies between organic and inorganic growth initiatives as the company transforms its business model through M&A deals. And here's a snippet of the different type of typical M&A deals that you can encounter when you're doing type of deals. You can have scale deals, you can have scope deals, you can do deals that actually is all about improving or enhancing a company's operational efficiency, or it could be about leveraging different things between the buyer and the seller, or between the two different companies involved in an M&A deal, maximizing the synergies and leveraging both companies together. Or it could be about just talent acquisition, R&D. It could be about acquisition of either patents, intellectual property, new products, or new access to research technologies, emerging technologies that you typically it would be more expensive to build on your own rather than just getting the access to the talent and the patents that already exist. You can also do it to diversify your business, meaning you expand not just across markets, but also across product categories. You're expanding your portfolio in addition to expanding markets and even the customer segments that you're selling into. And you can do it for specifically transformation. And transformation includes digital transformation for some of these companies that are looking to transform their business model. So going from a brick and mortar to being now an e-commerce player, That's about transformation. Those are the kinds of typical M&A deals that you can actually start looking, and we'll actually address in our approach the different types of deals, and we'll be able to tell you which one of these each company that we're going to be discussing, the case studies we're going to be discussing, actually did when we look at some of these deals that we're going to be studying. Also, scope deals rose in 2018 for the last 3 years between 2015 and 2018. Scope deals rose from 50% in 2015 to 66% in 2018 based on total share. So what that means is that more and more, as there's more deals moving forward, expect a lot more scope M&A deals to occur. And why is this important? Well, simple. When you compare any other M&A deal of the ones that we just discussed briefly earlier, scope deals are harder to get right, which means organizations need to have special teams in order to actually achieve the benefits of doing any M&A deal that is about increasing the scope of the company. And here's all the different challenges that come with the scope deal. The window of opportunity are very short, and you have to execute fiercely once you know that it's the right deal that you're looking for. And you can't procrastinate. You can't, you have to make decisions, and you have to do it because the window of opportunity closes very quickly and it's outside of your control. They're also usually more expensive than other because they require higher multiples to be paid for the target company. It also means that you have to assess the scalability and the vulnerability of IT systems and other technologies that are being used and shared as infrastructure for the company. And also, you may need to have new approaches to the way you do due diligence and integration. In addition to, it may require even more collaboration between both companies to be able to achieve the synergies. And collaboration starts not upon closing the deal, it starts before the deal is closed. So these are all the things and the challenges of scoping deals. The other thing is that most mid-market deals take usually 3 to 12 months, depending on the size and the volume of the companies involved, the sales volume of companies. But it also means that becoming deal ready for each company on both sides, the buy side and the sell side, or on both sides if it's a merger, usually take longer than the execution time frame for the deal to happen itself. So that means that both companies have to be well prepared in order for companies to actually achieve the synergies, and assume that if one or the other is not deal ready, that is either going to be stalling the deal, meaning it's like a likelihood that it's not going to happen at all, even though both parties are willing to do it, or it could be that you actually miss out on some of the synergies that the company is looking to achieve. So all of these become even more complex because becoming deal ready takes preparation, and most companies miss that fact. And this is why many deals fail either before, during, and even after a deal is closed. And if you want to be able to get good at doing this, you want to make sure that at least you start looking at all the early warning detection of all the things that you should know before even due diligence begins that are most important based on what you're trying to achieve. Because becoming deal ready means that you have to look at both your own governance, your working capital, your talent, the technologies that you're using within your company today, your accounting practices, how you plan, the set of advisors that you have access to, how you're continuing to optimize your own operations, and then look at your own competitors and what they're doing benchmarking across in your directly with your closest competitors across markets. And you also have to ensure the same has been done for whoever the target is, whatever company is the target. So that gives you a picture of the current situation and why M&A deals are so complex, and why sometimes you want to make sure that you get really good at understanding all the challenges involved before you actually even start focusing on inorganic growth initiatives. You need to figure out what does it mean for your company to become deal ready first, and expect that process may be actually longer than identifying a target or anything else that follows once you have begun the process of looking for the right targets and to acquire or merge with. So let's focus our discussion now as to how, if you're in a company and you're a project manager and you have been doing lots of organic growth initiatives and managing many development projects or organic growth initiatives, how is it that you need to prepare yourself as a project manager to lead inorganic growth initiatives? And we're going to talk about 9 different things that if you want to shift your career to start managing more and more M&A deals as a project manager, what are the things that you need to start developing on your own in your knowledge to actually become ultra successful at managing M&A initiatives within your company? So the first thing is that there's a difference between management and leadership. Management is about doing things right. It's about making sure that everyone in the teams understands what optimizing means and what are the things that they should be optimizing. That is management. Leadership is to ensure that everybody knows what is the right thing to do. It's about your company values and make sure that they're being followed. And it's also about make sure that you have ethical practices and procedures within your own organization. And that is leadership. So some of the things that we're going to talk about here have to do with developing management skills, but also developing leadership skills. And leadership skills may become more of building collaborative teams, even when these teams are not necessarily people that work full-time for your company. Figure out how to manage a team of experts, and those are the things that we're going to be discussing. So the 9 things, and just give a snippet of what we're going to be covering because we're going to get into more details. And by the way, those of you that have any questions on what I'm about to cover, make sure you are typing your questions using the Q&A portion, because the Q&A section, because there will be a moderator Q&A portion at the end of today's discussion. So number 1, we're going to talk about how to nurture a growth mindset culture within your company and why it's so important. Number 2, how to think strategically and then execute fiercely. Number 3, develop a consistent approach to how you manage and lead M&A initiatives. Number 4, how do you put together a playbook to something that you haven't been doing before if this is something that your company hasn't done previously? Number 5, how to build and nurture team of experts, even when those experts are outsourced experts. People that you don't have full-time, that you don't need to have full-time, but that you may need to access along the way once you begin the M&A process. Number 6, boost customer and shareholder value. And why is it important to boost customer value first? And how does that lead to also boosting total shareholder value for your company? Number 7, seek ways to achieve more synergies. Number 8, integrate quickly and responsibly. Once you have got started merger integration, how can you actually ensure that you're integrating quickly and responsibly? And then number 9, how to divest smartly, or how to divest wisely. These are the 9 things that we're going to be covering. So let's talk about number 1, nurturing a growth mindset culture. Why is this so important? Well, for those of you that have been working in different organizations, you know that at certain organizations you have, there's 2 extremes within the culture within any organization. The majority of people can be either on a fixed mindset, or the majority of people, including executives, can be on the growth mindset. And you might have a range of the population in between, but that usually dominates, what is the dominant culture that exists within your company? Is it a growth mindset culture, or is it leaning more towards a fixed mindset type of culture? Just giving you some perspective that in many organizations, what I've seen and some of the challenges that they face is that they're trying to do things that don't fit because they just don't believe that it's possible to do. And it's because the entire dominant culture tends to lean more towards being a fixed mindset type of culture. And that type of organization, I can tell you, the culture needs to change before you can get into inorganic growth initiatives to get them right. And so that means that you have to now figure out how to adopt a learning process within the company to actually, over time, and it's just part of what you need to do to become deal ready, is to start shifting the dominant culture within your company to become more towards a growth mindset culture. Because those are the kinds of, the culture is the right culture will apply to the right growth strategy that actually achieves positive growth. A growth mindset culture is what you need to be successful at achieving not just organic growth, but also inorganic growth that actually leads to growing, positive growth, lots of growth of your company. And you can adopt a process that allows you to train, coach, and mentor the right leaders within your company to start evolving your own company's culture to become more of a growth-minded culture. But that takes time. And it's part of the transformation that you need to do if your company is going to become deal ready. Here's an example of a company that just did this particular deal last year. Marriott, the largest hotel chain, and an opportunity that came to them, and they actually do quite a bit of both organic and inorganic growth across all the chains of hotels they own worldwide. Marriott, headquartered in Bethesda, Maryland, is the largest hotel chain, and the largest criticism they had received up until last year was that Airbnb has now grown at a faster rate, has more properties than the hotel chains that Marriott had at the time in 2018. Well, an opportunity came. Starwood owners, a privately held hotel chain, came to them and said, "Are you interested in buying us? Because we're ready to exit." And this was done in confidence, right? The CEO of Starwood came to the CEO of Marriott asking, would you be willing to entertain buying us? The CEO, and this is post announcing the fact that they actually moved towards acquiring Starwood. When they were interviewing him after the fact, they were saying, why did you decide to do this deal? Because this was actually quite a bit of investment. It was multi-billion dollar deal in order to do this. And he says, well, if you've been in this industry, in this market for as long as we have, you know that this type of opportunity comes once in a lifetime. And if we didn't move it, we would give it up to one of our competitors, and we did not want that. So it was a must for us. So what does that mean? Marriott, who has already been doing lots of organic growth initiatives, said they recognize that there are certain inorganic growth initiatives that only come once in a lifetime, and they don't really know when they happen, but they need to move very quickly to ensure that they can then achieve the synergies that they are looking for. The result is that deal has closed, and they're now in the process of doing merger integration. And Marriott, with this deal, is now the largest hotel chain and has more properties than even Airbnb has listed today. Not hotel chains, but just properties on Airbnb. Marriott is back on top as having the most rooms of hotels compared to any other in the hospitality industry. Number 2, think strategically, execute fiercely. It means that you need to have clarity that once you ensure that you have the right culture that can then feed your strategy, support your strategy, now you need to come up with the right action plan. An action plan that has a compelling growth story as to why it's going to make sense for you to continue growing organically and continue doing the things that are working for you when it comes to organic growth initiatives, but how in parallel you also need to now begin inorganic growth initiatives and how to create synergies between the two different types of growth initiatives. And that is what a compelling growth strategy should be is, what components you're going to be doing that are both organic and inorganic in the way you grow your company. And in order to ensure that the vision and the strategy is executable, make sure you actually devise it for execution so that you have not just smart, but smarter goals and objectives. Goals and objectives that are specific, measurable, achievable, relevant, time-bound, but also you have a way to evaluate once you have begun execution, and that you're able to adapt and readjust as needed once you begin execution. If you can get this right on organic, you can then overlay the same way of managing how you execute your strategy and in the way that you actually are managing inorganic growth initiatives. So doing this can help you get even better at organic growth initiatives, but it also can help you in making sure you get inorganic growth initiatives right as well. In addition, realize that a growth initiative is about figuring out how within your company you're going to have teams, special teams that are about designing and building a growth engine within your company. And that growth engine may be different for organic growth than it is for inorganic growth. And that sometimes the same company, the same teams have to support both growth engines. And these are some of the questions that you need to ask. And I think number 4 is the most important. Is your company today set up to design, build, and support not just one, but both growth engines, organic growth as well as inorganic growth, when you need to do both to grow, to continue to achieve a higher rate of growth? And for often companies, becoming deal ready is about figuring out how is it that you're going to use your current operating model, and how do you continue to transform and evolve your current operating model to close any strategy to execution gaps when these gaps occur on both types of growth engines that you want to now maintain and support. Here's an example of a company that did a deal a few years ago that actually is about a scope deal. And this was 2 global companies, very similar example to the Marriott and Starwood. And that example was about scaling the business because both were hotel chains that were already global companies. So the deal was about scaling the business for Marriott. P&G and Gillette, it's a scoping deal. So what I mean by that, Procter & Gamble has been around for a long time, and they've had over 30 product categories that they sell at any retailer that they actually have relationships with. And they're a global company that is selling multiple brands in any category. And they actually have a pretty comprehensive product mix that involves over 35 categories. Gillette is only one category, and that is razors. That's all they sell. And they were a global company. And Procter & Gamble had tried before to actually acquire Gillette, and were being told by the CEO, no, it doesn't make sense for us. Well, Gillette actually started losing shareholder value, and they actually had a change in CEO. And within a year of the new CEO coming on board, Gillette CEO approached Procter & Gamble and said, are you interested in a scope deal to acquire Gillette? And Procter & Gamble, the strategic brand managers within Procter & Gamble said, yes, let's discuss. So that discussion began, and it was over a period of failed attempts and discussions between the 2 companies that had failed under the previous executive. And when the company Gillette lost some shareholder value trying to regain and turn around the company, the new CEO that was brought in, his turnaround plan was to begin discussions with Procter & Gamble on how to actually enunciate, do the transaction of acquisition for Procter & Gamble in a way that made sense to both companies. And the result is that post-closing this, both companies have grown in size. As a matter of fact, today, Gillette is still has its own brand awareness. Very few people know that Gillette is now owned by Procter & Gamble, and they're basically using all the different retailers around the world that Procter & Gamble has access to place Gillette products in the same retail locations across markets. And the result is that share returns of both companies have gone up. And Gillette is still being tracked today financially separate from the rest of all of Procter & Gamble product categories that they're selling. Number 3, develop a consistent approach. The best thing you can do is to have a consistent approach is to ensure that you have a process in place that makes sense. And here is a 6-phased approach to any M&A deal. Any M&A process has a life cycle that involves 6 phases, from preparation to target screening to due diligence. That's all pre-deal. Then you have, once the deal has been agreed upon, now you need to figure out during, how to actually go about closing the deal. There's a lot of negotiations and transaction execution. And then after you close the deal, now you begin furiously executing on your integration. Integrated both companies and do it in a way that you can still achieve all the synergies. And there's also the last piece that most companies sometimes neglect, sometimes they don't even think about it, is divesting the things that are not needed. Because often there are things that you're not necessarily going to be necessarily want to be in, and you can actually start looking for the right qualified buyer that you can divest whatever it is that the resulting company doesn't need anymore and wants to exit that particular business and wants to give it to somebody else who's willing to buy whatever capabilities and talent they already have acquired. And that all happens post-closing a deal. So this is the way you can actually start looking at the life cycle of any M&A process. Regardless of the type of deal, you need to know what are the right tasks, activities, and deliverables, and the different team members that are going to be involved across each and every one of these phases. And overlay that on top of your already existing growth process. If you already have a new product development process and a way that you can maintain and support products already in market, overlay that process so that you can actually start looking at conceive and plan differently, because now whatever you're doing in conceive and plan is not about how much can you build on your own and who you can partner with. You can also be looking at what type of companies and which companies would make sense to acquire if this particular concept of whatever it is that you intend to do, you find out there's a market that is scalable and that you're getting traction. How is it that you start identifying targets as early as possible? The right type of companies to acquire. Not just partner with, acquire. So you can actually start overlaying over your existing organic growth process some of the things that will feed, some of the things that you need to do and initiate, investigate, and explore further when it comes to inorganic growth initiatives. So you overlay and you will repurpose your teams and start launching different types of teams at different times to ensure that you have a good balance between organic growth and inorganic growth initiatives. And make sure that you, just like you have a champion for organic growth at the executive level within any company, make sure there is an M&A champion, an executive assigned to lead inorganic growth initiatives. In most organizations, a holding company will have its own strategic business unit, and in that strategic business unit, there is an executive that owns inorganic growth initiatives for the rest of the company and all its business units. Here's an example of Caterpillar. Started with farming, then they shifted on to mining and construction equipment. And they provide very sophisticated machinery, heavy equipment for mining industries in addition to construction. And that they've been a leader, a global company doing that. a few years ago, they started seeing a rise of disruptors, companies like Komatsu and others that were backed by Japanese conglomerates and other companies, but mostly the one that has been expanding very quickly is Komatsu, that is now here in US, also targeting the same industries, mining and construction, not just in Japan, but also around the world. So what Caterpillar has done, they actually have partnered with Carnegie Mellon University in their robotics department, and also leveraging other companies that are not direct competitors like General Motors to start working on self-driving technologies that involve new sensors that they can place on their machinery at some point. So this is actually just exploring on things that may be about Horizon 2, Horizon 3, and not really knowing that they're going to be doing a lot of this on their own. Often they're going to have to choose the right partners, and then also maybe even look at the right acquisitions if they need to accelerate anything that they're already exploring when it comes to Horizon 2, Horizon 3 growth initiatives for Caterpillar. And this is an example of how Caterpillar is actually working on disrupting itself, because even though they don't have this type of heavy equipment available today, they're already working on figuring out how to make self-driving mining and construction equipment, heavy machinery that they're going to be deploying at some point when markets are ready to adopt self-guided, self-driving, or even remotely assisted heavy machinery for mining and construction applications. Number 4 is, how is it that you're going to adopt an M&A playbook? Just like you have an M&A a playbook for organic growth, you should have a playbook for inorganic growth initiatives. And this is what it's all about. It's about understanding what are the right processes that you need to have, well-defined processes, and the systems and structures and the tools that you're going to be using, and who are the people that are going to need access to all these things in order to actually make sure that any inorganic growth initiative is successful. And the playbook is nothing more than a combination of things that are best practices, enunciation of how this matches your company's values and ethics, the people involved, their knowledge and skills, the processes and tools and systems that need to be in place for anyone doing inorganic growth initiatives, templates of documents that need to be updated with content to make decisions for executives to make decisions, and then figuring out how to capture lessons learned as you go along the way implementing inorganic growth initiatives. And a playbook is not just applied in one phase of the life cycle, it's applied across every single phase that I spoke about earlier of anything that is M&A deals, before, during, and after. That's what the playbook should have. How you're going to be approaching things before a deal, how you're going to be approaching initiatives during a deal, how you're going to be approaching anything that has to do post-deal, whether it has to do with integration and or divestiture. Figuring out how to improve the playbook over time, improving your processes, improving the playbook, improving your tools based on lessons learned. And the way to expand your M&A capabilities should be about figuring out how to continue to have a playbook, and then how do you continue to learn from lessons and continue to improve the way you work and the way you and who you work with when it comes to inorganic growth initiatives. Here's an example of Discovery. Discovery Communications is a company that used to be headquartered in Silver Spring about 2 years ago, and began working. They actually had partnered with Scripps Networks. Scripps Networks is actually the publisher of any of these particular channels that are mostly available through subscription-based services like cable and streaming services. These are all the different channels that Scripps Networks had created over time. And many of them were licensed, or there were actually a partnership between Discovery Network and Scripps Networks. At some point, Discovery began, they liked the work that Scripps had done over time and the way they were working together, and started looking at the success of Scripps Networks, and they said, we want to help you achieve even more growth. And we see that you have a lot of new technologies that we don't have, that we could create synergies if we were to actually expand upon the partnership we already have. And these discussions about merging or acquiring were begun. Well, when it's all said and done, actually Discovery acquired Scripps Network. And in that move, they actually did several different things. They kept the headquarters of Scripps Networks in Atlanta, where they're at, which is where most of the technology is being done. All the technology development enabling all of these different channels and programs that were developed by Scripps continue to be done out of the same location. Discovery, in a sense, they wanted to actually get even higher brand equity to expand not just across North America, but expand globally. And that meant to them, and what they found out during this discussion process, is that it would make the most sense to actually move their headquarters from Maryland to New York City. And that's exactly what happened upon closing the deal, part of the merger integration, and achieving the synergies. The headquarters of Discovery Communications moved from Maryland to New York City, and the headquarters for Scripps Networks remained the same in Atlanta, Georgia. So that's what's been happening. And if you look at what's the shareholder, total shareholder value of Discovery, it actually has gone up since that acquisition for Discovery. So these are all the things, examples of companies that have actually used this process, and some of the success stories of recent M&A deals that have been closed. Let's move on to number 5. Number 5 is about building and nurturing expert teams. And nurturing expert teams means that now you need to continuously build your talent portfolio. If you are managing projects within any company, you're continuously recruiting not just from within the company. Often you need to also then be looking outside of your company and figure out what is the right talent to bring in or outsource work to when you need to, not just for organic growth, but also for inorganic growth initiatives. And figure out how to extend your capabilities through outsourcing to the right experts. So building a talent portfolio is not just about identifying talent within your company, it's also about identifying the right talent that you need to bring on board when you need to outsource to expert advisors when you need it. And for inorganic growth, expect that you will need to go outside of your company, because typically this type of expertise is not available in-house for most companies. Then focus on the shared values and their experience and figuring out how to collaborate and how to create teamwork between your own people and the people that you're going to be outsourcing to. And here's an example of what Uber has done over time. Uber, the current Uber that we all know and has been expanded now as a global company, it also has been exploring self-driving cars. And actually at some point, they're planned to actually start implementing their own self-driving vehicles that you can actually start hailing via Uber. So at some point, we're going to see, when the market is right, that when we hail an Uber, it's not going to have a driver. It's going to be a self-driven Uber car. That's what they're working on right now. And they actually started looking at what others are already doing. And Waymo is one of the companies that is already doing this. Waymo is actually owned by Google, which is now owned by its holding company, which is Alphabet. And Waymo is a leader today in self-driving vehicles, because Waymo is the one that right now is in the process of coming up with commercial vehicles that is the same kind of vehicles that you see today, collecting photos and video information for Google Maps using the Google Mobile, because those are already self-driving vehicles that Google owns. And all they're doing is continuing to gather more video and photo information, that they're actually improving the experience for anyone using Google Maps and any application that is a location-based application like Google Maps. So Uber, knowing that they needed to now start sort of leapfrogging what Waymo is already doing, started looking for the right partners. And they actually found a suitable partner in Carnegie Mellon University, which I mentioned earlier, had already done partnerships with companies like GM and Caterpillar to develop self-driving vehicles, part of their robotics faculty department. They were the best and the brightest at robotics, and they actually had a national center they started a few years ago, back in the, I believe it was sometime in the late 2000s, around 2008 is when this National Robotics Engineering Center started within Carnegie Mellon. And because Uber couldn't necessarily buy the entire Carnegie Mellon University, they actually need the next thing, and that was really more of a talent R&D type of deal. They actually created a partnership with Carnegie Mellon's National Robotics Engineering Center, and ultimately ended up hiring not just the faculty, but many of their doctorate and postdoctorate staff that were a part of this robotics center, and they actually implemented their own R&D almost down the block from the Carnegie Mellon National Robotics Engineering Center. And that is what Uber has done to actually leapfrog or accelerate having a self-driving vehicle. And they're already doing today testing of vehicles in one of the states that they actually are doing market testing of their own self-driving vehicles, all different sorts of vehicles, once they actually were able to draw in the talent from Carnegie Mellon's National Robotics Engineering Center. So that was purely a talent acquisition. From a partnership, they went into a talent acquisition where now many of the faculty that were working at Carnegie Mellon's National Robotics Engineering Center is now working at Uber's R&D center, located just down the block from this particular engineering center. Number 6, boost customer value. And why is it so important to boost customer value? Well, I can tell you one thing. Eric Ries, the author of Lean Startup, says often you can't just assume that you know buyer behavior, because buyer behavior changes outside of your control. No matter how much value you offer, buyer behavior changes, and you need to figure out not really what they want and anticipate what they want, not just based on what they're saying, even when you are interviewing them or surveying them or sampling them. You need to actually test and know what they really want versus what they need, because those two things are different. And very few customers are sophisticated enough to actually be able to enunciate what they want versus what they need. And you need to have clarity as a vendor as to how those things change over time when you're targeting a specific portion of any population in any market. And studies show, this is a McKinsey study that actually looked upon multiple vendors across industries, and they showed that the ones that actually were able to grow and diversify their customer base were not only about retaining customers, and the retention was mostly done by providing more and more value to those target customers without necessarily asking for a much higher price to whatever they're already buying. So they were able to upsell and retain by upselling and delivering a lot more value every time they upsell or cross-sell into segments. Focusing on that, understanding how to actually enhance your unique value proposition to your customers compared to your competitors is a moving target. And that's something that you need to have clarity on, is figuring out how to continue to add more value as perceived by your target customer segments and do it better than any of your competitors in order to retain. And as you retain and grow your customer base, your shareholders will see the value of you being able to not just only retain and upsell and cross-sell to those segments, but also acquire new segments, because now those customers that you are retaining, they're now loyal, and they're now saying great things about your offering and the value proposition that you're offering them, and making sure that they are telling their friends and family to buy more from you, just like they are. And that becomes an ongoing feedback mechanism, that the more value you deliver to your customers, the more that you actually are able to capture new customers, that now translates into higher total shareholder value. And that's what you want to do. Here's what Walmart did, because Walmart, about 10 years ago, they saw how Amazon.com was actually growing faster as an online reseller compared to Walmart retail stores, when Walmart was mostly doing a lot of sales on brick and mortar retail locations, and they were the largest. They actually went and started acquiring smaller companies, and one of those acquisitions that they did was located in Silicon Valley, and they over time converted that into Walmart Labs. And those of you who are not familiar with Walmart Labs, that's a self-standing business unit that is purely responsible for actually increasing e-commerce solutions for Walmart, the holding company. And here are some of the acquisitions that have come out since the Walmart Labs were created about 8 years ago. They actually have acquired Jet.com, they've acquired Flipkart, all of these acquisitions they've done, not only acquisitions, but they've also have done new partnerships that Walmart before never had. So they've done both partnerships and acquisitions based on whatever Walmart Labs, whatever work they've done through Walmart Labs. And that has equated where last year in 2019, Walmart.com was growing faster in online sales compared to Amazon.com in US. And that was actually a first, because they were able to show that Walmart.com was actually outselling in many categories the same categories that were being sold in US through Amazon.com. That's what Walmart has created, new KPIs to figure out whether or not their inorganic growth is working for them. And they actually came with a very unique value proposition that they actually launched an entire marketing campaign right before the holidays in North America, and that is a video of a service that they implemented that went viral, that a specific commercial went viral very quickly on YouTube. And that is that they actually have developed the ability where you can buy online and then pick up on a drive-through, where they actually have reserved parking spots at known Walmart locations near you, where you can just drive up and pick up whatever you bought online. So no need to even get off your car. Somebody will come in and know that you get the status of your orders. You're telling them you order online, and via the mobile app, you're telling them, I'm coming in to pick up at this time. And by the time you show up, all you do is drive up. They'll bring you the whatever you bought, and then you can just pick up and go. And that is a very innovative, unique value proposition that today Amazon.com can't do in as many locations as Walmart can today. And that was a very innovative value proposition that came out from all the acquisitions and partnerships that were launched through Walmart Labs. And that process started for Walmart about 10 years ago, and they started now actually been increasing the synergies between their brick and mortar and also their online business. And both have been growing, but online business has been growing at a higher pace than the brick and mortar retail sales. Number 7, seek ways to achieve more synergies. And what I mean by that is that most everybody's saying, as I mentioned before, yes, inorganic growth does pay off. However, but most organizations are saying most mergers under-deliver, most M&A deals under-deliver. And this particular study that Bain actually published last year, or 2 years ago actually, said that when the executives that are involved in inorganic growth that they interviewed, 55% of them said that the deals that they actually did failed because they overestimated during the process the synergies that could be achieved in a realistic way. And that's where the majority of failures are happening today for most companies that have been doing inorganic growth. And we're going to talk about why that is, and part of that is because of the things that we discussed earlier. Many of these deals are shifting from being scale type of deals to being scope type of deals, And the complexity of scope deals is higher than scale deals. And that's part of the reason why you have this big amount of failures even after deals are closed. Now, acquirers who announce synergies usually enjoy stronger returns. This is a study that actually McKinsey published about 2 years ago. And they actually looked at years of information of companies between 2010 and 2017 and figure out the ones that actually announced synergies during that transaction execution phase and the ones that did not announce synergies after the deal was closed. And they found that the ones that actually announced synergies before they began the integration process usually do better and yield higher shareholder returns when they actually do what they announce what they are going to do and then they do it. It's about integrity. It's about creating trustworthiness with shareholders. And that's the outcome of this particular study. So if you really want to overachieve in the synergies, make sure that you announce before you begin integration what you intend to do. And use the process of during transaction execution to actually identify as many synergies as possible. And realize that synergies can be about new revenue streams or higher revenues or on current revenue streams that already exist within companies. Lowering your cost structures or transferring, you going from capital expenses to operational expenses, and even further, turning some of those expenses from variable cost structures to fixed cost structures that can be scaled without having to incur a lot of variable cost structures. Have access to working capital and also have access to other financial vehicles when you need to structure deals. Those are the different kinds of synergies you can create, and all of these, you want to be able to furiously identify these before the deal is announced, but also through transaction execution before you begin integration. And the more of this that you identify and the more of these that you announce and that you can start then deploying once you begin integration, the higher the likelihood that you're actually going to actually get the right growth rates that you're looking for. Here's an example of a company of a recent mega billion acquisition. CVS Pharmacy had been expanding for a long time organically. They already have over 9,000 locations, and 2 years ago, they were growing at around 300 new locations in North America alone as a pharmacy. And one of those organic growth initiatives, they actually had partnered with Target stores. So now that you start to see a lot more Target stores where now the pharmacies within those Target stores are actually being run by CVS. And it's a partnership between Target and CVS. Well, that had been going and working great, that partnership. When they started looking at, this is not really outdoing what we really know we want to do. We need to look for more. So they actually started looking at other type of acquisitions that made sense. And they started looking at health insurance providers. And they actually started working with one, and not the one that's here, but actually they were turned down by regulators because they did make the approach and actually had made an offer, and the regulators said no. They learned from that and kept them. They had a list of suitable targets. They moved on to the next target, and the next target on their list was Aetna. And they announced this. They actually closed the deal, and this deal was closed about, I want to say in November of 2018. And just in December, last month, 2019, they announced that both companies have now achieved much higher shareholder return than expected. And that is because they actually announced synergies as they were closing the deal, when they were still doing the transaction execution and looking at ways to actually do the right integration of both companies in a way that the market share of health plans that Aetna is selling goes up, but also the medicine prescription as over the counter and sales for all CVS retail locations is also growing at the same time. And both companies individually are growing. The pharmacy side of the house is growing, as well as the health providing side. The health plan provider is also growing in sales. And that has equated to higher total shareholder return only a year after they began on integration. Not quite really done on integration, because if you look at the size of these companies, I think it's still, one of maybe a total of 3 years. We're at the end of year one, but already within year one, they've achieved positive shareholder returns of both companies. Number 8, integrate quickly and responsively. I mentioned earlier that you can have many ways to do the type of deals, and the more synergies you identify during transaction execution and that you announce those is a way to actually be able to do. Here's the other thing. There are different ways of doing integration, and each one has its own trade-off. Number 1, stage optimization. While it is easier to execute and less cost involved, less work, less cost involved in doing, it also doesn't give you all the synergies or as many synergies as you might need to actually add or increase total shareholder value for the resulting company. Usually to achieve more synergies, you have to do full potential optimization across everything that the company is doing, the entire product mix and the operations and the way you manage and you structure the business itself. And that is more costly and it takes longer. This is the type of integration that CVS and Aetna is doing. And this is why it's not just a 1-year approach. It's actually 3 years to complete a full potential optimization. But if you do this right, full potential optimization, when planning it and estimating what is your intended value that you intend to deploy first, you're still able to get higher total shareholder return over time from year 1 to year 2 to year 3, when you know how to plan and estimate what integration means to actually achieve the synergies that you intend to achieve, the most important synergies that you must achieve in order to get the right shareholder return that you want to get. And all of this means that you have to have specialists, advisors who have done this right to figure out what is integration and what does it take to achieve the synergies between the two companies involved during the transaction execution. So there are different ways and different questions. This is just a guide as to what are the things that you should be aware about, picking and choosing one of these 3 preferred ways to integrate based on the number of synergies that you need to achieve. And this is just for your own reference. I can tell you an example of companies that is doing this on an ongoing basis, and that is Amazon, because Amazon.com, the way that it's been expanding its business as an online reseller is by looking at whoever's already leasing infrastructure and platforms as a service from its most profitable line of business, which is Amazon Web Services. And over time, the companies that are already leasing either infrastructure and or platforms and are getting the right traction within specific categories that as online resellers that are already using AWS infrastructure and platforms, they're actually acquiring some of those companies. Companies like Zappos, for example, that started as a shoe online company, and now they're still in the market, but now they're owned by Amazon.com. And that's what Amazon is doing to grow the scope and the breadth and across markets, scaling their online reseller business that they started 25 years ago. Now they're expanded to not just online with their latest acquisition that was actually, they're in the process of now integrating Whole Foods. They're actually now becoming a grocery chain, and now they're looking for synergies between Amazon.com sales and the Whole Foods side of the house, which is strictly food and grocery stores at retail locations. And they've already been achieving some value And they're trying to figure out a lot of different things because Amazon.com was never a retailer. And now they're trying to figure out how to actually start achieving the right synergies between the retail side of Amazon and the online side of Amazon.com. Number 9, divest smartly, which I would also say you want to divest wisely. It's been shown that not only the people that actually can achieve synergies, but then can continue to maximize total shareholder return, they don't stop at after they're done with merger integration. After they're using to figure out how they can repurpose or reuse or sell, divest, exit certain aspects of the business when there's players in the market that may be willing to continue in that space. And the top divestors usually, another study performed by McKinsey and Company published in the last 2-3 years, looked at the top performers, and they said the top performers will outperform the market, not just the company divesting, but also the divested company. They both win when divestment is done wisely. And becoming great at divestment takes special teams that most companies don't have within their companies, even when they have inorganic growth already going on. Divestiture it's a specialty that you need to make sure that you have access to the right advisors to help you figure out how to divest wisely. And here are some of the rules that most everybody who has been involved in doing this is saying. Number 1, make sure you have a dedicated team, no different than what we're saying about the M&A lifecycle and inorganic growth process. You have a dedicated team, even if it's an outsourced team of experts. You can also have a dedicated team for just divestitures. Test the fit and value in the market. Figure out, plan and replan and plan again how you're going to detach that aspect of the business and still maintain the side of the business that you want to still play in, and figure out how to create a compelling value proposition that is not just for the target buyer that's going to now hold this divestiture, but also employees on the divested side that you intend to sell, and also the target buyers' employees. Because you need to create synergies between the two. And you need to get really good at identifying those things, because this is not about, just typical things that in the way you run your business. This is not about optimizing your operations. It's about figuring out how to optimize somebody else's future operations. That's what divestment means. And this is why it's so hard. United Natural Foods Incorporated actually is a food distributor that about 2 years ago, they actually purchased the holding company that owns Shoppers. And Shoppers, they have 44 locations. Most of them are in Mid-Atlantic area. And they have, they're a very close competitor in a more smaller way to Walmart stores. They're not super centers. They're just typical grocery stores with a cost leadership model in the way they implement. And they have 44 locations in Mid-Atlantic. Well, 2 years ago, United Natural Foods Incorporated bought the holding company and announced its intent to divest the grocery stores side, including Shoppers as a brand. Just last month, they began shutting down Shopper stores without even announcing to the public this fact. And overnight, a local store that is available, that is near where I live, just put up store closing, everything must go signs. And this was around the DMV area where I live. 13 of 44 locations are currently closing, previously unannounced. What do you think the press is saying about all these stores that are letting go of employees that were never told anything until the last minute, and now they're being told you're closing within the next 2 weeks? That's the announcement that they've made. And not only the consumers don't know about it, their own employees didn't know about it, and now they're having to figure out how to just exhaust inventory to close those stores. And they've already announced in some of these locations that there's a new buyer, but there's no plan as to how they're going to transition the current employers of the stores that they're closing and the new employees that the new buyer that now intends to have a grocery store at some point in the future. How are they going to transition? There's no transition plan for employees. So this is an example of a company that, even though they made this acquisition with an intent to divest, their approach to divestiture is not the right approach. And what most people are saying is that they're most likely just going to fail at the end because it's bad brand reputation for the actual food distributor, in addition to whoever, the employees that don't have a plan as to what's next for them, because they were just told a few weeks ago or, overnight, we're closing the store and it's going to be done in a few weeks. So this is an example of a current divestiture that is ongoing here in North America that is not being done right in accordance to what we're saying. To summarize, we've gone over 9 different things that if you want to start leading inorganic growth initiatives within your company, these are the things that you want to figure out how to actually get really good at as a project manager or as a leader within your company. If this is something that has appeal for you, these are the things that you want to make sure you understand: business models, how to study and understand markets, customers, and how to study customer behavior, identify how to create synergies between 2 different companies, understand operating models of the 2 companies and figuring out how to merge them together the right way, and make sure that you have clarity as to why it needs to be done in certain ways in order to achieve the synergies that allows you to grow your customer base, but also increase total shareholder return for your shareholders. And more of an FYI on key steps to have successful digital M&A deals. And if you want to look at this now, I mentioned earlier, it takes longer to become deal ready for any company if you have not done this before. And you can either figure out how to do this or we can help you. You can reach out to us. But it can start with just asking these questions within your company. Where do we want to be in the next 10 years? And what does that mean that we need to be now 3 to 5 years from now? And what do we need to be working on today? And how do we prepare for what's coming and what we need to do to achieve our vision of where we want to be 10 years from now? And identify the plan, the processes, and the people that will be needed to ensure your company is deal ready, no matter whether you're going to be doing a merger acquisition or you're going to sell a portion of your business or the entire business to somebody else who that's part of your growth strategy. These are all things that you want to have clarity on in the way you would plan. And make sure you have an inorganic growth champion in your C-suite, an executive within your company assigned to own inorganic growth initiatives. And as we get the Q&A, and any questions you can type in on the Q&A portion. But I want to say this entire deck is now available, already posted. I'm going to share a short URL where you can actually view this entire presentation, and you can look at other presentations that I've done in the recent, that we as Byond have done. We can also go and follow this particular link to download this particular ebook that is free for you to download, a little bit about our services, and then my contact information. And here is the link that you can use to actually view the entire session. And I'm going to share the same information via chat so that you can just go there and view on your own time after today's discussion. And all in preparation for Q&A, I will then share this information and ask Wendy to come in and take a look at any questions. But also, if you have any questions on any material that I covered, I know I covered a lot of material, we can actually go into the Q&A at this point.
Great. Thanks so much, Hector. Yes, anyone that has questions, please feel free to post them in the chat or the Q&A function. of WebEx. We'll give folks a moment to do that. And as Hector said, if you think of something later today or in the days ahead, you're also welcome to reach out to him directly with any questions.
And Wendy, one of the things one of the questions that I often encounter is, if we haven't done this before as a company, can we do this on our own? Can we prepare ourselves? And the answer is yes, you can, but you need to make sure that you have the right guidance. You bring in the right experts who can guide you as to how to prepare your company to become deal ready. And this is the kinds of things that we do for clients. And we focus specifically on mid-market companies, specifically technology and software companies that are mid-market companies, as I pointed out earlier. And we typically work with companies that are beyond the startup mode, but now and have gotten some growth, but they know that they want to actually start getting the hockey stick type of growth in the way they're growing their business. And often that means that not only do they need to continue doing organic growth, they also need to now start exploring inorganic growth initiatives, and they should be looking at, how to prepare the company to become deal ready to start exploring inorganic growth initiatives. So I wanted to just kind of focus on that, because that's a question that I often get from different stakeholders when they're asking, hey, can we prepare on our own? And yes, the answer is yes. There's a lot of information, but you want to make sure that at least you bring in somebody who can guide you and can either train you, coach you, and work with specific stakeholders within your company to make sure that you have the right structures in place, the right systems, the right processes, and that now you can start training and growing leaders within your company to start now executing on inorganic growth initiatives.
Great, thank you. And just a few reminders. The PDU code for today's webinar will be sent to you via email. If you would like to become a premium member of the Great IT Professional, you can go to our subscribe page at greatpro.org/subscribe. Premium membership is $199 per year. It does allow you unlimited anytime access to the online library of over 1,000 free PDU hours. You can also try out our mobile app for free at greatpro.org/mobile. I don't see any questions at this time, but Hector's contact information is on the screen, and as I mentioned, please feel free to reach out with any questions or for any advice going forward. If you have any questions about the Great IT Professional, you can reach me at wendy.nolan@cai.io. So thanks everyone so much for joining us today. We hope to see you at future events. And Hector, thanks again for joining us today. We certainly always appreciate you sharing your time and knowledge with us.
Well, thank you so much. It was really fun, Wendy, and I hope to see you again at some point in the future. We will be announcing some additional future topics of Webcast that we're doing with you. So I'm looking forward to doing that in the first half of 2020. So thank you very much.